Welcome to our comprehensive guide on Indian income, tax law and practice. This course is designed to equip you with a practical understanding of the key provisions of income tax law in India. By the end, you'll be able to confidently compute the total income and tax liability for individuals, applying the law to real-life scenarios. Start with the basics, build up your conceptual foundation, and then move step by step through each head of income, deductions, and the final tax computation. Whether you're a student, a working professional, or just curious about how taxes work in India, this course will give you the clarity and confidence you need. Let's outline what you'll achieve in this course. First, you'll master the core concepts of income tax, including key terms and the importance of residential status. Next, you'll learn how to compute income under each of the 5 main heads: salary, house property, business or profession, capital gains, and other sources. Finally, you'll bring it all together to calculate an individual's total income and tax liability, applying deductions, rebates, and the latest tax slabs. Each unit builds on the last, ensuring a logical flow and practical understanding. Let's understand what a tax is. A tax is a compulsory financial charge imposed by the government to fund public services like roads, defense, and healthcare. In India, taxes are broadly classified as direct and indirect. Direct taxes, like income tax, are paid directly by the person who earns the income. Indirect taxes, such as GST, are paid by consumers when they buy goods or services. The Income Tax Act, 1961, is the main law governing how income tax is calculated and collected in India. Understanding key definitions is crucial. An assessee is anyone liable to pay tax under the Act. The term person includes individuals, families, HUF, companies, firms, and more. The previous year is the financial year in which income is earned, while the assessment year is the year following, when income is assessed and taxed. These definitions set the stage for all tax calculations and compliance. Residential status determines how much of your income is taxed in India. An individual is classified as resident or non-resident based on their physical presence in India during the previous year. Residents are further divided into ordinarily resident and not ordinarily resident based on additional conditions. This classification affects whether global income or only Indian income is taxable. Understanding these rules is essential for accurate tax computation. Scope of total income depends on residential status. For residents and ordinarily residents, global income is taxable in India. For residents but not ordinarily residents, only income earned or received in India and income from business controlled from India is taxable. For non-residents, only income earned or received in India is taxed. This distinction is vital for anyone with income sources inside and outside India. All income is classified under 5 heads for tax purposes: salary, house property, profits and gains of business or profession, capital gains, and income from other sources. Each head has its own rules for computation, exemptions, and deductions. This classification ensures that every type of income is taxed appropriately and consistently. Certain incomes are specifically exempt from tax, such as share of profit from a firm, interest on public provident fund, and agricultural income. Agricultural income, defined as income from land used for agriculture in India, is fully exempt. However, if your non-agricultural income exceeds the basic exemption limit, agricultural income is considered for rate purposes under the partial integration rule. Income from salary includes wages, annuity, pension, gratuity, fees, commissions, perquisites, and more. For tax purposes, salary is taxed on a due or receipt basis, whichever is earlier. There must be an employer-employee relationship. The computation starts with gross salary and allows for specific deductions under Section 16, such as standard deduction, entertainment allowance, and professional tax. Allowances are cash payments for specific expenses, such as dearness allowance or house rent allowance, HOA. Some are fully taxable, some partially exempt, and some fully exempt. Perquisites are non-cash benefits like rent-free accommodation or a company car. These are classified as fully taxable, taxable with conditions, or exempt. Understanding these categories helps in accurate salary computation. Key deductions from salary include the standard deduction, a flat amount for all employees, entertainment allowance for government employees, and professional tax, if paid by the employee. These deductions reduce the taxable salary, making it important to claim them correctly during computation. See how to compute taxable salary. Start with gross salary, subtract the standard deduction, entertainment allowance, if applicable, and professional tax. The result is the taxable salary, which forms the basis for further tax calculations. This systematic approach ensures accuracy and compliance with the law. Income from house property is taxed in the hands of the owner, including deemed owners. The property must not be used for the owner's business or profession. The tax is based on the property's annual value, which is determined by comparing municipal value, fair rent, standard rent, and actual rent received. Compute the annual value, compare the municipal value, fair rent, and standard rent with the actual rent received. The highest value after adjustments becomes the gross annual value, GAV. From GAV, subtract municipal taxes paid by the owner to arrive at the net annual value, NAV. This forms the basis for further deductions. Main deductions are allowed from net annual value, a standard deduction of 30% of NAV, and interest on borrowed capital. For self-occupied property, the interest deduction is capped at $200,000 per year, but for let-out property, there's no limit. These deductions significantly reduce taxable income from house property. Let's walk through a practical example. Suppose the gross annual value is Rupee 400,000, municipal taxes paid are 30,000, and interest on loan is Rupee 150,000. Subtract municipal taxes from GAV to get NAV. Then deduct 30% of NAV and the interest amount. The result is the taxable income from house property. This process is the same for let-out, self-occupied, or deemed let-out properties, with minor adjustments. Profits and gains from business or profession cover income from any trade, commerce, manufacture, or skilled profession. The computation starts with net profit as per the profit and loss account, then adjusts for disallowed expenses and allowable deductions under the Income Tax Act. This ensures only the correct taxable profit is considered. Allowed deductions include rent, repairs, insurance, depreciation, and scientific research expenses. Disallowed items include personal expenses, excessive cash payments, and certain statutory payments made after the due date. Understanding what can and cannot be claimed is crucial for accurate tax computation. Small businesses and professionals can opt for presumptive taxation under Sections 44AD, 44ADA, and 44I. Here, income is presumed as a fixed percentage of turnover or receipts, simplifying compliance and reducing paperwork. This scheme is ideal for those with lower turnover or receipts and minimal expenses. Capital gains arise from the transfer of a capital asset, such as property, shares, or jewelry. The gain is taxed in the year of transfer. Assets are classified as short-term or long-term based on the holding period, which affects the applicable tax rate and eligibility for indexation benefits. Compute capital gains, start with the sale consideration, subtract expenses on transfer, and then deduct the indexed cost of acquisition and improvement for long-term assets. The result is the gross capital gain. Apply exemptions, if eligible, to arrive at the taxable capital gain. This method ensures fair taxation, considering inflation and reinvestment. Sections 54, 54B, 54EC, and 54F provide exemptions from capital gains tax if the gain is reinvested in specified assets, such as a new residential house or certain bonds. The exemption is limited to the amount reinvested or the actual capital gain, whichever is lower. These provisions encourage reinvestment and asset growth. Income from other sources is a residual head that covers any income not taxed under the other four heads. Common examples include dividends, interest on securities, winnings from lotteries, and gifts above a certain limit. Each type has its own tax rules, with some taxed at special rates and others at slab rates. Winnings from lotteries, crossword puzzles, and similar games are taxed at a flat rate of 30%, with no deductions allowed. Gifts of money or property received without consideration above Rupee 50,000 in a year are taxable, except when received from relatives or on special occasions like marriage. These rules prevent tax evasion through windfalls and gifts. After computing income under all heads, aggregate them to find the gross total income, GTI. In some cases, income of another person, like a minor child or spouse, is clubbed with the assessee's income to prevent tax avoidance. Clubbing rules ensure fairness and prevent misuse of tax provisions. Losses from one source can be set off against income from another source under the same or different head, subject to certain rules. If losses cannot be fully set off in the current year, they can be carried forward to future years. This mechanism helps smooth out fluctuations in income and ensures fair taxation over time. Chapter VIA of the Income Tax Act allows for various deductions from gross total income. Popular sections include ATC, investments like PPF, LIC, ATD, medical insurance, and ATG, donations. These deductions reduce your taxable income, making tax planning more effective and rewarding. Section ATC is the most widely used deduction, allowing up to Rupee 150,000 for investments in PPF, life insurance, tuition fees, and more. This section encourages savings and investment while reducing your tax bill. Remember, the aggregate limit applies to all eligible investments combined. Other important deductions include ATD for medical insurance premiums, ATTTA for interest on savings accounts, and ATG for donations. Each section has its own eligibility criteria and limits. Claiming these deductions correctly can lead to significant tax savings. Rebates and reliefs further reduce your tax liability. Section 87A provides a full tax rebate for resident individuals with total income below a specified limit. Section 89 offers relief for arrears of salary or pension. These provisions are designed to support small taxpayers and those with irregular income. Final tax computation involves several steps. Calculate total income after deductions, apply the relevant tax slab rates, subtract any rebate, add surcharge if applicable, and finally add health and education cess. This systematic approach ensures you arrive at the correct net tax liability. India offers two tax regimes: the old regime, which allows major deductions and exemptions, and the new regime, which offers lower rates but fewer deductions. Choosing the right regime depends on your income structure and eligible deductions. Understanding both helps you optimize your tax liability. Let's compare the two regimes with an example. Suppose your gross total income is Rupee 15,000,000. Under the old regime, you claim deductions like ATC and standard deduction, reducing your taxable income. Under the new regime, you get a higher standard deduction but fewer other deductions. The final tax liability can differ significantly, so always compute under both regimes before filing. Section 54 allows exemption from long-term capital gains tax if you sell a residential house and reinvest the gain in another residential house within the specified period. The exemption is limited to the lower of the capital gain or the cost of the new house. This provision encourages reinvestment in real estate. Suppose you sell a house for Rupee 90,000,000, incur Rupee 1,000,000 in expenses, and the index cost is Rupee 35,000,000. The long-term capital gain is Rupee 54,000,000. You buy a new house for Rupee 45,000,000 within 2 years. The exemption is Rupee 45,000,000, and only the remaining Rupee 9,000,000 is taxed at 20%. This example shows how Section 54 can significantly reduce your tax. Let's practice a typical house property calculation. If the municipal value is Rupee 3,000,000, fair rent is Rupee 3,60,000, standard rent is Rupee 3,20,000, and actual rent received is Rupee 4,000,000, the GAV is Rupee 4,000,000. Subtract municipal taxes of Rupee 30,000 to get NAV of Rupee 3,70,000. Deduct 30% standard deduction and 150,000 interest on loan to arrive at taxable income of Rupee 1,090,000. Business income computation starts with net profit as per accounts, but tax rules require adjustments. Add back disallowed expenses like personal drawings or excessive depreciation and deduct allowable items not in the accounts, such as tax depreciation. This ensures only the correct taxable profit is considered. Small businesses and professionals, presumptive taxation under Sections 44A and 44A simplifies compliance. Declare a fixed percentage of turnover as income, and you're deemed to have claimed all deductions. This scheme is ideal for those with simple finances and minimal expenses. This head covers income like dividends, interest, lottery winnings, and gifts. Winnings are taxed at a flat 30% with no deductions allowed. Gifts above Rupee 50,000 from non-relatives are taxable, but gifts from relatives or on marriage are exempt. Interest is usually taxed on an accrual basis. Aggregate income from all heads to get gross total income. Clubbing rules add income of certain relatives to prevent tax avoidance. Losses can be set off within or across heads, and any unabsorbed loss can be carried forward to future years, subject to specific rules for each type of loss. Chapter VIA covers deductions like ATC investments, ATC-CD 1B, NPS, ATD medical insurance, ATE education loan, ATG donations, ATTTA-TTB interest on savings deposits. Each deduction has its own eligibility and limit. Deductions are not allowed from certain special incomes like LTCG and lottery winnings. After all deductions, apply the relevant slab rates to the total income. Special rates apply for long-term capital gains and winnings. Subtract any rebate, add surcharge if income exceeds certain limits, and finally add 4% health and education cess. The result is your net tax liability for the year. PAN card is a mandatory 10-digit alphanumeric identifier issued by the Income Tax Department. It's essential for filing tax returns, opening bank accounts, investing, and conducting high-value transactions. Without a PAN, higher TDS rates apply, making financial life difficult. Apply online using Form 49A through NSDL or UTITSL. As a practical exercise, identify 5 individuals above 18 years without a PAN card. Explain its importance, guide them through the online application process, and help them fill out Form 49A. This task reinforces your understanding of PAN's role in the tax system and helps others become tax compliant. Finally, apply everything you've learned by performing a complete tax computation for an individual. Calculate income under all 5 heads, aggregate to find gross total income, apply Chapter VIA deductions, compute total income, apply tax slab rates, deduct rebate if applicable, and add surcharge and cess to find the final tax liability. This hands-on practice cements your understanding and prepares you for real-world tax scenarios.